So this video is all about home purchase financing, so mortgage financing. So let's start off and just cover some terminology and some basic concepts. So what is a mortgage? So a mortgage is a type of loan, and what is special about it is that it has a security interest in a piece of real estate. And in this case, it's going to be this home that you're purchasing. So the lender not only has given you a loan, they also have what's known as collateral in the form of the house that is being purchased. So they have, in some ways, a shared ownership with you. It's not a direct ownership, but if you stop paying the loan, then the bank has recourse directly to the asset. They can basically take it over and sell it. Obviously, there's some trade-offs there in the fact that you can have your home kind of taken over by the bank if you stop paying. But the good part is that because the bank has this security interest, they can offer you a loan at a lower interest rate. So, that's kind of the trade-off. Okay, borrower and lender. So you, the home buyer, is going to be the borrower. The lender is going to be a bank. There's also just financing companies that finance mortgages. So they're going to be basically providing the money for you to do the purchase, and in exchange, you're going to pay them interest, and they will also take a security interest in the property because it's a secured loan. Okay, so principal and interest. So you will be making a fixed payment on your mortgage. So let's call it, you know, $1,320 a month. So even though, and let's say you take a 30-year loan, this payment is going to be the same every month for the entire 30 years. But part of it is interest and part of it is principal. So let's say you had borrowed initially $500,000 and it's at a 3% interest rate. So, and actually, let's look at this in Excel. So remember this 500K at 3%, and let's do the math in Excel. Okay, so your principal is 500K, and so and our interest rate is 3% per year. Okay, so in Excel there's a function called payment. So PMT. So it's gonna first ask us the rate, okay? And so it's a little tricky because this is an annual rate and we want a monthly payment. So we're gonna divide this by 12. Number of periods. So if we're taking a 30-year loan and we want a monthly payment, it's gonna be 360 payments. PV stands for present value, so that's basically the principal of the loan. So it's gonna be 500K. And so we see here that the payment is going to be $2,108 per month. So this is our monthly payment. Okay, so now just let me show you how the principal and interest works. Okay, so the payment is fixed. This is going to be the same payment every month. And so this is month one, two, three. So let's just do the first year. Okay, so, and we know the interest is going to be the starting principal at the beginning of the month times 3% divided by 12. Okay, so that's the interest portion. The principal is just going to be the payment minus the interest. Okay, and now what is the starting principal for the next month? So we had $500,000, but we see here that of this 2108, $858.02 was principal. So in the next month, our principal balance is going to be lower. So we see here that the principal drops. And so I can just, now it's the same formula. So in the next month, you see here that the interest is a little less because you're paying the same 3%, but you're paying it on a smaller amount. So this has dropped a little bit. And because our payment amount is the same, the principal went up a little bit. So you can see basically there is an increase here and a decrease in the interest. Okay, so if we just apply this down, okay, so you see here that after a year, we've paid down around $10,000, $9,557 of principal. Okay, you can see the balance has dropped. And what's interesting is that let's do the second year. Okay, so from in the first year we saw that we paid off $9,552 approximately. So now let's see what happened in the second year. So we went from month 12. So you see that we paid off more. Okay, so that's because the interest amount continues to drop, the principal amount continues to rise for as a proportion of this fixed 2108. And if you did this all the way down to 360, you would eventually just get to zero. Pretty much all of the this 2108 will turn into a principal payment, and the interest will be very low because the balance keeps dropping. So this math that PMT function does is to figure out what is this payment that makes it perfectly happen after 360 payments. So, so you can see here that over time, basically, even though you're paying the same amount, there's a different proportion between principal and interest. You're paying more principal versus interest as time goes on in the loan. Okay, so there are different types of mortgages in that some of them have a fixed rate of interest. And in the previous example I did in Excel, it was 3%. That was a fixed amount. Some mortgages will offer what's known as an adjustable rate. So uh, interest rates change over time. It's dependent on the supply and demand for money, and in the banking sector, it's very complicated. Predicting interest rates, people get paid a lot of money to try to do it, and no one can really do it perfectly because it's just kind of a market. Interest rates uh, and mortgage rates are function in a market, and it's very difficult to predict. But basically, they change over time. So an adjustable rate can take advantage of times where the interest rate drops. So if you think that the interest rate is going to drop over time, then if you take an adjustable rate mortgage, you'll be better off because your rate that you're paying on the interest will also drop. Also, a lot of these adjustable rate mortgages will offer you, for example, a teaser rate at the beginning. So they'll basically give you for the first 2 or 3 years 2% interest, and then it will jump up to a market rate of interest plus a spread. So they're giving you this as an incentive to take the loan, but your interest could jump up to 7%. After a couple years, after 3 years, and your payment is gonna proportionately change because unlike a fixed rate mortgage, which is what we did in the Excel, the payment amount is going to change for an adjustable rate mortgage depending on what the interest rate is. So if you have such a large interest rate change, the payment is going to go up a lot. And during the 2008 financial crisis, what a lot of people were doing prior to that is taking out these very low interest rate teaser rate loans, and then after 3 years, right before it was going to reset to 7, they would just get a new mortgage because their property had gone up in value, and they were able to just get a new mortgage, get a new teaser rate. It's like with internet, Xfinity will offer you a 1 year kind of reduced price, and then after that it goes up a lot. But if you just get Xfinity for 1 year and then switch to AT&T the next year, and then you switch back to Xfinity, you can play this game of just keeping your internet rates low. But the problem is if they stop offering those special deals, your payment is just going to go up a lot, and that's kind of what happened to a lot of homeowners during the financial crisis, and they weren't able to afford the new payment when it reset to a higher rate. So adjustable rate mortgages are not for the beginner. It's not for the person who's stretched financially for the home, because your payment can go up a lot. So a lot of people, just for managing the risk, opt for a fixed rate. So an appraisal is a report basically where someone comes in, is a third party, and evaluates what they think the property that you're trying to buy is worth. So they'll look at what other similar properties have sold in the same neighborhood and do an analysis and give a appraisal, independent appraisal of what they think the value is. And so this is valuable to a bank because they don't care actually what you're paying for the property. They want to know what it's actually worth in the market. So the appraiser is a third party who can give an unbiased opinion, because if you're trying to buy the house, you may think it's worth a lot more than it actually is. But the bank wants to protect itself against that because they're lending you a certain amount based on what the property is worth, and they want to make sure that the value of the property is accurate. Underwriting is the process by which the bank will put you through to either approve or reject you for the mortgage. So they will ask for all your bank account statements, and I'm going to actually talk about what they'll ask for. But basically, underwriting is the process by which the lender does its due diligence on you to determine if they want to lend to you or not. Foreclosure. So I mentioned that the bank or the lender has a security interest in the property. So if you stop paying, the way that the bank basically can recoup its money is through a process of foreclosure, meaning they avail themselves of the rights of this security interest that they have, and they will often try to sell the property at an auction, or they'll basically become the owners of the property. If no one buys it at what's known as a trustee sale auction, the bank then becomes the owner, and then they'll fix up the property. They'll do whatever they need to fix it up and resell it. But the process by which the bank basically takes back ownership of the property is foreclosure. So obviously you want to avoid that, because if you go through foreclosure, your credit report is going to get very negatively impacted. You're going to lose your home. If you put a down payment on the house, you're potentially going to lose all of that. So, you want to make sure that you can afford the house that you're buying, and not go into this foreclosure, because you'll lose your house. Basically you will lose ownership of the property if the bank forecloses on you. So there's different types of financing schemes. So if you're buying the property for yourself to live in, you're going to get preferential kind of rates on the mortgage interest. The underwriting is a little different and more lenient if you're an owner-occupied property, versus if you're buying it for an investment property. There's more kind of restrictions in the underwriting and more stringent restrictions for investment property. And the logic there is that the bank thinks that if you're buying it for yourself and you're living there, you're going to fight much harder to make the payments and not give up the property so easily if something happens to it. So they feel safer with the owner-occupied property than lending money to an investor to buy an investment property. Okay, so what do underwriters look at when they're underwriting you? So there's the DTI, which is your debt to income ratio. And so for conventional mortgage financing, it's typically, I think they look at, they want a 43% debt to income ratio. And so what are the debts that they'll consider? They'll consider the mortgage payment, any credit card payments, child support. So these are all the payments that you're going to have to make. The debt service, so let's say the mortgage payment is going to be $2,000. You have car payment, credit card payments of another 500, and then child support. Let's say you pay another 500 per month, and then your monthly income is it's going to be your gross income. So it's going to be your pre-tax. So let's say you make $6,000 a month. So that's going to be 3,000 divided by 6,000, which is 50%. So in this case, it would be too high. Again, they want to keep you at 43% or lower. So let's say instead you didn't have these credit card or child support, you're at 2,000, which is, 33%. So in this case, you would be okay for a conventional mortgage. So of course, there's levers. You can either keep this low or you can increase this to get your debt to income ratio kind of in line with what they're looking for. So loan to value. So the lender is only going to lend up to a certain percentage of the value of the property. So if the appraiser says that the property is worth 500K, the maximum loan to value (LTV), let's say it's 80%. The lender is only going to give you 80% of the money. So they're only going to give you, what is this, 400,000, and you'll have to come up with the rest of the 100K to buy the property yourself as a down payment. And the reason why the banks do that is because they want you to have skin in the game. They want you to put up some of your own money so that, you're not going to just let the property go because you have an investment in it. So it aligns your incentives with the lender. They're going to look at your credit score. So that number, again, the credit score is really important. It comes up in much of your financial life, including getting a mortgage. So they will want an explanation for any issues that are on your credit report. And obviously, they will just want a high score. They'll ask for employment verification, so pay stubs. If you have a business, they're going to want to see information on your business income, and you're gonna have to verify that. The easiest income to verify is like if you have a job and you get, just the W-2 and a paycheck every month. That's the easiest kind of income source for a mortgage lender to underwrite. If you have a business or you have kind of more unstable earnings, then getting a mortgage becomes much more difficult. So, that's kind of one very big plus to having just a regular 9 to 5 job, that it's easy to get mortgage financing. And then you're going to have proof of funds for the down payment. So, I gave this example where you're going to have to put up 100K. So they're going to want to see that you have the funds available either through your bank accounts as cash. If you have investments like stocks, gifts, you're going to have to prove that you're going to have the financial means to make this down payment and just kind of have cash available. Tax returns. So they'll ask for your previous year tax returns, W-2, which is what you get if you have just like a regular job, which kind of summarizes your earnings from the job. So they'll ask for all this stuff too, and they basically will take all this information and synthesize it into an analysis as part of the underwriting process, and will determine if they want to lend to you or not. Okay, and so what are the different types of mortgages that are available? So most people are going to get conforming, or what are known as conventional mortgages. So these meet the federal lending standards. So I mentioned the 43% debt to income ratio. That's part of the federal lending standards for a conventional mortgage. So they're a cheap source of mortgage financing because they're kind of subsidized by the government. You've probably maybe heard of Fannie Mae and Freddie Mac. So these are two quasi-government enterprises. So they're technically private businesses, but they're really kind of backed by the government, and they provide a indirect subsidy, you can say, to the mortgage lending market. And that's, how they do this exactly is kind of outside the scope. But basically, these guys will make certain standards for lending, like the 43% DTI, 80% LTV loan, the loan to value. They'll have different standards for their underwriting, and most lenders will conform to the standards that these guys have set, because they're the conforming mortgages. There's a secondary market Basically the bank will give you the loan, but then they can sell your loan to someone else. And so if it's a conventional mortgage, there's a market for them to be able to sell it. So that's a little technical, but basically these federal lending standards are what most lenders will use to underwrite your mortgage. Yeah, so as I mentioned, the banks and finance companies will originate your loan, but usually sell it off to these Fannie and Freddie or to the mortgage market. So the conventional mortgage can be used for your primary, secondary, or investment property. But again, the underwriting standards are different for these different classes of property type. So they're pretty strict, compared to the days of like 2008, where there were unconventional mortgages that were, there were a lot of unconventional mortgages. The conforming conventional mortgage standards are pretty strict. So you have to be a pretty safe kind of borrower profile for qualifying for a conventional mortgage. There's flexible down payment options. So if you don't have 20% down payment, there are there's ways to get a larger mortgage, even a conventional mortgage. There's what's known as PMI, private mortgage insurance. So you have to actually just pay more every month, but you can get insurance to kind of cover that extra amount. And you could only put down 10% rather than 20%, and the bank will lend you the extra amount, but you'll have to pay this insurance on that difference. So you will end up paying more per month, but you won't have to put up as much upfront. And so for some people, that's the better option because they just have trouble saving or whatever the reason. So there are some flexibilities for the down payment for conventional mortgages. There's the FHA loans, and so these loans are for lower credit score and lower down payment buyers. They're more expensive in terms of interest rate and just the fees and stuff than a conforming mortgage. So you have to pay for mortgage insurance up front. There's a kind of fee, and then ongoing, you just have to end up paying a higher amount per month. But it is a good option for especially first-time home buyers that maybe don't have as much saved up. It's kind of a good first-time home buyer, younger person option. Many sellers, though, don't like to see offers that are financed by FHA because it just shows that the buyer maybe is a little weaker financially and maybe will have trouble closing on the deal. So for kind of prime markets, where if you're trying to buy a house like in a really good area, it may be a liability to actually have an FHA loan as part of your offer package. So that's just something to consider. But if it's like track home somewhere in the suburbs and it's like or you're out in Texas somewhere in a suburban place where there's just a lot of like smaller kind of homes, FHA loan should be fine. But just know for you too, you're gonna end up paying more in insurance and interest over time. So though you're getting in, you're gonna just be paying more on an ongoing basis. But it still may be worth it because just getting into the real estate market, the appreciation on the house and all that may definitely offset the extra cost. So it may be worth it just to get into the market using a FHA loan. Okay, if you're a veteran, the VA has a mortgage scheme available to you. So this is a VA loan is for military veterans. They're really low interest. They will finance 100% of the purchase price. So with the 500K house, the VA loan will cover all 500K. They'll give you a loan for 100%, and without mortgage insurance. So if you're a veteran, this is a mortgage you should certainly take advantage of. It is a really sweet deal. There are also kind of non-conforming mortgages, so like interest-only loans. As I showed in the Excel spreadsheet, with a traditional kind of amortizing 30-year loan, meaning it gets paid off totally at the end of the term, fully paid off. An interest-only loan has no principal portion, so you're only paying interest. So that lowers the payment amount, but you basically have to continually always refinance the loan because you're not paying any of the actual principal off. But some people will take on this type of loan because they just want to keep their payment lower, and they're just banking on the fact that they'll be able to refinance the loan continually. And so there's certain situations where you may want to do that. It's riskier, but if you're thinking that your house is going to appreciate a lot over time, then it may be a good option. So large balance, jumbo, and super jumbo. So these are for markets where the home prices are very large, like in California. If you're trying to buy in the Bay Area, you can easily spend, $1.5 million or $2 million on a house. The conventional mortgages have a limit to the mortgage amount. However, a large balance jumbo or super jumbo loan can basically exceed the balance for the conforming Fannie Freddie loans. And the advantage also is that there's more flexibility in the underwriting. So as opposed to a conventional mortgage, which is very formulaic, you have to kind of fit into the framework by which the conventional mortgage standards, lending standards are written. But a portfolio lender or non-conforming mortgage has more options on underwriting. So if you're kind of a small business owner, or you got if you own a bunch of real estate and you got weird stuff happening in your tax return, there's more you can do with the portfolio lender and with non-conforming mortgages. So HELOC, home equity line of credit, that's what HELOC stands for, or in a second mortgage. So if you bought a house 10 years ago and you bought it with a mortgage and your house has gone up in value a lot, you can get a second mortgage or a HELOC, which will allow you to borrow against the increased value of your home. So let's say you bought it for 100K and you had an $80,000 mortgage on it when you first bought it. And let's say this is like in 2000. And then in 2020, your house is now worth 500K. You still have only, let's say even you've paid off, let's say you have 50K balance on this original 80K. So you only had 20K in equity, meaning your ownership here, but now you have 450K. Okay, so a bank will say, okay, this person has $450,000 of equity, meaning ownership, because they only owe $50,000 on the mortgage. The house is worth 500, so that means that the owner of the house has 450K of home equity. So a lender might say, okay, I'll on top of this 50K, I'll lend them another 200 because they have 450K in home equity. So you'll be able to now have your 500K home. You have a 50K, sorry, this is a minus 50K in the original loan, and now you've taken a new loan of 200. So you've reduced your home equity. You now only have 250K. But now you have $200,000 in your pocket as cash. So this is cash. You've just taken out a new loan. So then now you can invest this in other things, or if a lot of people unfortunately spend it on cars and stuff that depreciates in value. So you've kind of partially sold your property to get this 200K out. And it's not a bad idea if you plan on investing it in something, but if you're just going to buy stuff with it and consume it, that's maybe not such a good long-term strategy, because you've kind of mortgaged your future, literally. You've taken home equity, part of your net worth, and you've spent it on stuff that is not going to give you any return in the future. Okay, and then there's hard money. This is going to be the most expensive form of mortgage financing. They do not care at all about your income. They won't care if you even have a job. They will only look at the property. So they will, if your property is worth 500K, they will have a much lower LTV. So they're not going to give you 80%. They may only give you 50%. So they'll give you 250K. But you're going to pay a really high interest on this because, again, they're not looking at your income at all. They don't care who you are. They just care about this 500K property. So if you don't make any payments, they're going to just take it over. And they're happy to do that because they're lending you so little as a percentage of the total value. So if you're a lot of real estate people do this because they have a lot of assets, they have real estate, but their income may not be so strong because they're speculating on land, for example, and though they have a lot of land, the land doesn't generate any income, so they may have to take out hard money. And if they had some other investment they wanted to pursue, And so they're going to end up paying a high interest rate, and the term is shorter. So like a conforming mortgage, you can get a 30-year loan. A hard money loan may only be like 2 years. So you'll have to figure out how to pay the mortgage back in a shorter amount of time than a fully amortizing just regular mortgage. And so this is kind of the spectrum of all the financing available.